Are you looking for information about a 2-1 buy down? Well, you're in the right place. Hi, this is Scott Hastings with Mortgages by Scott. And with interest rates, getting on up there, uh, some people need a little bit of relief when it comes to payment. So there's a great option. I really love this product that's come out. And, you know, disclaimer, this is not necessarily for all people. It's not for all situations, but in the situations where it does work, then it really works well. So what is a 2-1 buy down? In general, what a 2-1 buy down is, it's a mortgage where for the first year, the interest rate is 2% below what the current interest rate is. So if we take the example that I have on the screen, I basically have 6.5% rate loan. That's about where rates are today with a small discount. For the first year, it would be as if your payment was 4.5%. The next year, it would be as if your payment was at 5.5%. And then for the third year, it would be the full 6.5%. And then that would be for the remainder of the loan. So on this particular scenario, I've got up here a $500,000 purchase with a $375,000 loan amount. So if you look here at the bottom of the screen, the first year, the payment, and these are, taxes. This is a real property in Mecklenburg County that's on the market. The payment would be $2,195. So then the second year, the payment would be $2,424. And the third year, it would go up to the payment, where it would be for the rest of the loan, the next 28 years, $2,665. So one thing that's nice about this loan is it's not an adjustable rate mortgage. This is a fixed rate mortgage. What's going on is that the seller of the home, or the new home builder, somebody that can't be the buyer, is really paying about 2% of the loan amount to lower the interest rate. What happens is that money, let's just say it's, in this case, a $375,000 mortgage, just to make the math easy, let's say it's $400,000 mortgage. So the seller would put $8,000 into an escrow account. The lender would use that money for the first 2 years to make up the difference in the payment between where it really is 6.5% and what the payment's being made at, in this case, for the first year, 4.5%. Now, I can't say for certain that rates are going to go down in the future, but the experts in the field are forecasting their rates will go down, and they're at historically high levels. And the really reason that is because of inflation. So what the experts are seeing is that as soon as inflation gets under control, which they think will be in 6 to 12 months, then mortgage rates should start to come back down. If they do come back down, I think they will. Most likely you're going to refinance this loan. Probably everybody that's getting mortgages right now in the 6.5%, 7% interest rate range, they're going to be able to refinance. Let's just say they get down to 5, 4.5. Who knows? But most likely you're going to refinance out of this probably before it even steps up to the full payment at 6.5% in this example. So what would happen if, let's say, a year from now, you're able to refinance the loan, and let's just say lower the payment to whatever, where it is now, 4.5%. Well, there would still be some money left in that escrow account that the seller had put in with the lender to make up for these payments, so you could have a lower payment. That money that's left over, you would be able to take that and pay down the balance on your mortgage. So it's not like it's lost money. So the difference between, let's say, just, you've heard about paying points to buy down a rate. The difference between you just buying down the rate is that in this case, if you refinance, you're going to get some of that money back. Now, again, can't say it's an absolute. We can't say for sure that rates are going to drop in the future. But they're the highest they've been in, well, probably 15 years. So most likely they will. And historically, there is a refinance opportunity about every 2.5 years. So although I can't say for certain, it's very likely that rates will drop. Now, you may want to just use that $10,000, or in this case, $8,000 seller credit to just buy down the rate. Maybe instead of, maybe you could buy the rate down to 5.5% from 6.5%. Just have a 5.5% rate for the whole term of the loan or until you refinance. You could do that too. So anyway, I hope that this is something that makes sense. If you would like to, see an example of what it would look like in your particular situation, you can just reach out to me. My website is mortgagesbyscott.com. If you like this video, please click like and subscribe. That would really help me out. And yeah, hopefully this was helpful.